Welcome to another Motley Fool conversation. I'm Andy Cross, joined here by fellow investor at the Motley Fool, Jason Moser. We're really thrilled to be joined by Barry Ritholtz. Barry Ritholtz is the co-founder, chairman, CIO of Ritholtz Wealth Management, a financial planning and asset management firm with, now $6.4 billion under management. Barry was an early financial blogger pioneer, along with the Fool around the same time, launching his Big Picture blog in 1998 over at GeoCities. And it's still ongoing. I'm glad to say I love reading that, Barry. He's also the creator and host of weekly Masters in Business podcast series, which you can find on Bloomberg. His book, How Not to Invest, I hold right here in my hand, published in March of this year. Welcome, Barry Ritholtz, to the Motley Fool. Thanks for being here.
Well, thanks so much for having me.
Barry, the book is just full and chock full of great stories, investment wisdom. It's as much as a behavior finance book, I think, as almost anything, and we'll get to it. I do want to say, really, you've distilled this wisdom in this book from over those just thousands and thousands of words you've written, articles, blogs you've written, podcasts you've given. You really chose mistakes to kind of like zone in on to start this book. Why did you do? Why that approach around mistakes as opposed to writing like another how-to book on investing?
Well, the ugly truth is there have been thousands, maybe tens of thousands of how-to books written over the past, 50, 100 years. And despite all of this information telling you what to do, most people are still pretty mediocre investors. And it's not because of the things they're doing right or failing to do the things that are right. You could do everything right, but if you make just a handful of small mistakes, they have devastating consequences. And, Bailout Nation came out in 2009, and I've had publishers kind of harangue me for a while. Hey, let's do another book. Hey, you should do a how-to book. And my answer was always, what good is that going to do? And it was really during the pandemic, kind of just going through notes. We all had a little extra time on our hands, that it dawned on me the last thing in the world that anybody needs is another how to invest book. But hey, how about how not to invest? How about if you could just avoid these mistakes, how much better off you'll be? And once I kind of came up with the framework of bad ideas, bad numbers, bad behavior, I don't want to say it wrote itself, but it laid itself out very nicely.
You know, it's funny because you quote Charlie Munger at the very beginning, don't try to be smarter than anyone else, just be less stupid. And I feel like I'm kind of like eating my spinach before I get to my dessert. Like you're giving me these kinds of like, oh my gosh, these great lessons you've observed over your years and years of investing wisdom to start with those mistakes. And you make the parallel with tennis, professionals. It's not, it's about making those unforced errors that we have to be very, very cautious about in investing.
That's right. Tennis is a good metaphor. Driving a car on a racetrack is a good metaphor. And investing, basically the problems happen when we try and operate out of our skill set and expertise. So the example the other Charlie gave, Charlie Ellis, in winning the loser's game, was it's really two games in one. The games the professional play and the game that the amateurs play. We're recording this. Djokovic is, on pace to possibly winning yet another Grand Slam event, and folks like him win by scoring points. They have incredibly powerful serves. They hit with great precision. They use all sorts of fancy spins. They kiss the line. That's not how I play. And when I lose, it's because I double fault on a serve. I hit it long, I hit it wide, I hit it into the net, or I hit it right back to the sweet spot of my opponent. All those mistakes lead to unforced errors and points for the other side. If you want to win, just when you're playing the amateur game, not the professional game, just make less mistakes. Just don't try and overpower the ball. Don't try and be too fancy. Keep it away from your opponent, but don't think you're going to just kiss the line. You don't have those skills. And so we see when people operate outside of their own ability, that's where they make mistakes that cost them money. And in the markets, that means, hey, I'm going to exercise my judgment on, I'm going to create an all personally picked stock portfolio. I'm going to time the market. I'm going to follow this news flow and bet on my understanding of what's going on and what it means for the markets, when the reality is that news is already in the price. There's no advantage to taking public information and thinking that you're going to be able to trade against the professionals. Trade against the guys with 150-mile-an-hour serves.
Barry, forgive me, I probably would have gone with golf as the metaphor, but that's just me. But the lesson rings true. I mean, you just avoid the silly mistakes, the unforced errors. And I really enjoyed the book. It seemed like a predominant theme in the book leaned a lot more towards passive investing versus active. And to be sure, you presented data to back that up. But I guess I wanted to ask, what's your general view on active investing, and what would you say are the keys for active investors to outperform?
Sure. So the first step for assembling a broad portfolio is, hey, you can't get alpha if you aren't at least starting with beta. And you'd be surprised how many people just neglect that. So I love the idea of making the core of a portfolio. I describe it as your Christmas tree should be your passive portfolio, and your active selections are the garland, the lights, the ornaments, all around that. But if you at least start with beta, hey, you're at least going to get what the market takes. We've learned on that active does much better on the bond side than passive does. So you have to be really selective where you're applying passive investing. You have to have a degree of awareness. Stock picking is so hard. And the problem isn't that, in fact, the data shows professional managers are really good stock pickers. They're really bad stock sellers or stock holders. So look at the biggest companies out there, the leaders in the market: Microsoft, Nvidia, Apple, Amazon. Go down the whole list. They've all had incredible drawdowns on their way to becoming trillion-dollar companies. I mean, when AI came out, we heard that this is the end for Google, and a lot of people lightened up on Google. It took a big hit, and now Google is double what it was when I think Anthropic first launched in 2022. Yeah. So it's so much more challenging to, just because something rolls over and draws down doesn't mean it's the next Enron, WorldCom, Lehman, Bear Stearns, whatever. And so recognizing that it's really a challenge. Look at the drawdowns you saw following the .com implosion in Microsoft, Apple. Amazon was a $5 stock in the early 2000s. It's sort of unthinkable. And Apple, when the iPod rolled out, was a $15 stock with 13 cash, and nobody wanted to touch it. So you really have to be very aware of what your ability is. Hey, if you want to pick stocks, well, knock yourself out. Just do so with a smaller portion of your portfolio, and make sure you actually have some skill at it, not just finding the winning stocks, but understanding how to hold them and when to finally cut them loose.
All right, so getting back to mistakes, because that, is really what the book is all about, how not to invest. And you had a nice section of the book on investing mistakes, and given this is a conversation about how not to invest, what would you say are a few of the more common mistakes you see investors make today?
So it depends on where people are in their investment cycle, how old or young they are. What we've known, and I'm going to give you a lot of stuff that comes straight from the data. What we've seen in the 2010s, it started to change in the 2020s. Young people were taking too little risk. They were underinvested. Hey, if you're 25, 30, even 40 years old, and you have a time horizon that's measured in decades, not years, if you're 25, you have a 40, 50-year time horizon, why would you be sitting on a pile of cash and or bonds? You should be pretty much, if not all equity, because some people that's a little too aggressive, mostly equity for the long haul. And a combination of a broad index and pick your favorite stocks for the next 20, 30, 40 years works better than, so that's one issue we see. People wildly underinvested when they should be embracing risk. The other end of the scale, we see people in their 50s and 60s, heavily concentrated portfolio, lots of wealth in a single stock. It could have been an employer, it could have been inherited stock. hey, why are you taking all this risk? You're already sitting on a giant pile of money, enough to last you the rest of your life. Throttle back. So that those are two of the bigger allocation mistakes we see. The other mistake that leads to more mistakes is simply not having a plan. Like, more money for the sake of more money doesn't really do anything. It's got to be, what do you want this money for? Once you figure out your goal, hey, then you could figure out the appropriate risk tolerance to get to that goal over time. So when we see hedge funds that just lever up, 10, 20, 50x leverage in pursuit of more, they invariably blow up. If your goal is more, then how much risk is too much risk? That doesn't guide you. But on the other hand, if you say, hey, I'm saving for retirement, generational wealth transfer, philanthropy, you could create a plan and then marry that plan to an allocation that accepts as much risk as you're comfortable in order to achieve your goals. Now, the challenge is risk and reward are two sides of the same coin. Mm-hmm. If you want higher reward, well, then you're going to have to take more risk, and risk means you may not get what you want. And so, I love the definition of risk is risk means more things can happen than will happen, and some of those things that can happen aren't good. So how much more risk do you want to assume? We feel you want as much risk as necessary to get to where you have to go, but not a whole lot more than that.
Barry, you mentioned the fascinating fact that it's not so much the buying, it's the selling where investors fall down. And just a quick study that you reference in your book looked at what they call the counterfactual portfolio of random sells of more than 780 institutional portfolios, and the random sells outperformed the portfolio of active sells by 50 to 100 basis points over the following year. And so my question to you is, why do you think that it's the selling part that investors tend to get so wrong? Because you juxtapose that against the study from Henrik Bessenbinder that shows that 1% or so of the stocks in any given long-range period drive almost all of the returns in the stock market.
Right. The Bessenbinder study found, depends on the country, 1.5, 2, 2.5, depending on what part of the world you're looking at. But the good buyers, bad sellers, I think my explanation makes a lot of sense. The buying process is quantitative and rational. You look at the world, hey, what stocks are reasonably priced? What momentum is going up? Who has a moat? Who has a good product? Like, there are a lot of different schools of thought you can sift through to try and identify those tiny percentage of stocks that do well. And historically, managers have been pretty good at that. And I keep coming back to, it's rational, it's logical, it's quantitative. The selling part becomes really squishy, right? So first, every manager has a finite amount of money. Nobody has an infinite amount of money. So very often when something else comes along, well, we got to sell something to get the capital to buy something. And so you're selling early. You're not giving that stock that you put all this time and effort into researching enough time to develop in the fullness of its revenue and earnings growth. So that's number one. Number two, we see a lot of fund managers when there's a little bit of a squiggle, when there's a little bit of a issue, when a stock falls somewhat, they either panic and sell, or as we've also seen, when it's not just a modest pullback, when there's a fundamental change in the business model, when there's competition, when something happens that should make you go back to your original thesis and say, hey, the reasons I bought this are no longer in effect. We see other managers riding these stocks down to single digits from giant gains. And all of these seem to be decisions that are emotionally driven. Mm-hmm. So you have the hard mathematical buys and you have the soft emotional squishy sells. And that's why knowing how long to hold something and when to sell it, I feel like it's a lot more art than science, whereas the selection process seems a little bit of art, but a lot of science as well. And so selling is just much, much harder.
It's interesting. Sorry, Jason, just a quick follow-up is that the behavioral side to the decisions on the selling side is arguably more important than on the buying side.
That's right, because you can take a winning trade and give up the big wins. I described my terrible trade in Apple, which was a triple.
Yeah,
Worst trade I ever made. And on the other hand, if you allow either your emotions or your just failure to understand why you own something to get in the way, and look, the reality is all of us investors are humans, and we're filled with flaws. We weren't built for this. We adapted and evolved to survive in a hostile world. Deciding how long to hold the stock was not part of our evolutionary history. And so when your fight or flight response kicks in, someone just asked me, I don't understand, investors underperform from like 2010 to 2020 a little bit, but they wildly underperformed in the 2000s. Why is that? And my takeaway was, well, 2010 to 2020 was pretty much straight up. Yeah, 2015, Q4 2018, not great. But it was a robust bull market. You just had to be invested and not make mistakes. So maybe people weren't fully invested. Maybe they made some mistakes over that decade. The underperformance was almost triple in the 2000s. And so you're coming off of the dot-com implosion. So my experience, I just know firsthand, a lot of people entered 02, 03 wildly underinvested. They panicked out in 08, 09. We saw a capitulation. The bottom formed in March 09. Capitulation means surrender. People panic sold in 09. And there's another study I reference in the book that says when people panic sell, about a third of them never return to equities.
Yeah.
So if you want to know how you underperform by 5-6% in 10 years, hey, tap out and miss the entire recovery that followed from March 09 forward.
Yeah, I was fascinated at that statistic that so many people just don't even bother getting back in. I was kind of taken back by that. And Barry, one of the things I really enjoyed about the book, I enjoyed the psychology, the behavioral aspects of it. And I like that you dug into the Dunning-Kruger effect. Mm-hmm. And so for those who are unfamiliar, can you explain what the Dunning-Kruger effect is and how it applies to investors?
As I hold my University of Michigan mug up, as you referenced, Barry.
But it's funny because I have family at University of Michigan, so I dropped a little footnote, and I'm shocked at how many people picked up on the Go Blue reference. So David Dunning and his University of Michigan psychology professor and his grad student, Justin Kruger, did a study to determine if our metacognition, which is a fancy word for how good are we at evaluating our own skill set, right? And the assumption tends to be that if you're good at something, you're pretty good at evaluating that skill set. And it's not quite right. It's not quite a one-for-one curve. In the beginning, our metacognition of our skill set, when we have really poor skills, is awful. And even as we continue to develop skills in that, we're still far, far below where the experts are. It's more than just overconfidence. It's how hard can it be? I love asking a room full of people, how many people here are above average drivers? Mm-hmm. 3/4 of the hands in the room go up, maybe more. And, I'm a car guy. I've taken every high-performance advanced driving class there is, and they're all just thinly disguised defensive driving classes that try and teach you, stay within your own ability, stay within the car's ability, and if you operate within yourself, if you make fewer mistakes, you'll just do so much better. So Dunning-Kruger is not only the tendency for us to misevaluate our skill set and underappreciate how difficult a subject is, but then when you go to the other end of the scale and you talk to experts and you have them self-evaluate, they know how difficult things are. They tend to underestimate their own skill set because they're aware of how random the world can be, how challenging and complex things are, that everything you do is dynamic and affects everything else, and then there's this feedback loop. And so So the idea of Dunning-Kruger is our ability to self-evaluate improves over time, and it starts out really bad and eventually catches up as our skills get better. Now, apply this to investing. Look at what took place during the pandemic with newbie traders and the checks that had gone out from the government and meme stocks and just, hey, how hard can this be? Those guys are a bunch of idiots. I could do this better than them. And so you see like just the classic errors more than overconfidence. Where the species as a whole is overconfidence, we can't help it. If we weren't, wait, a bunch of us are going to go down with sticks and try and take down that mammoth. The cave that's overconfident goes down and does that, and they have fur and meat for the weekend, for the winter. Hey, maybe not everybody else comes back to the cave, but most of us are going to do better. The folks that lack that initiative tended not to survive. And so pop psychology 100, evolutionary biology, we have this tendency to a bias towards action. Of course I think we could do this. Why wouldn't I? How hard can it be? And so that bias towards action leads us to doing things perhaps beyond our own ability. Takes a while for your metacognitive skills to actually develop so that it's not just that you have really good skills, it's that you're really good at evaluating where you are on that scale.
Barry, one factor that might play into this a little bit is this concept of signal and noise with all of the information that's out there. And you quote Ian Castle, was a friend of the Fool, a great investor, who says the maturation of every investor starts with absorbing almost everything and ends up filtering almost everything. How can we be better filters of that noise and focus much more on the signal?
Yeah, especially today when you have such a diversity of media and Substacks and beehives and social media and blogs and podcasts. I think you really have to be selective in what you do. The joke is your mom taught you this when you were a kid. Don't take candy from strangers. So before you go out and say, oh, I heard this guy talking about this and I'm going to go buy this asset class or that stock or whatever. Hey, who's this person? What's their track record? Do they have a good temperament? Have they been through a few cycles? Do they know what's going to happen? Have they seen how the movie ends? Like I'm fond of pointing out that anyone who ran around with their hair on fire in the first quarter of 2020, hey, maybe that's not the best person to take your stock advice from because, as we saw, eventually the market kind of figured out what was going to happen. So create an all-star list of people who are worthy of your attention. I'm not saying you have to just have a list of people who've never said anything wrong. Look, people are going to get things wrong, but you want them to be more wrong than right. You want them to have a process that's defendable, not just occasionally getting lucky. And lastly, and most important of all, you want them to be seasoned. You want them to, not just be starting out with not knowing what a bear market is like, not knowing what an interest. Up until 2022, we had a whole generation of bond managers that had never really lived through a rate hiking cycle. And so you need a little seasoning. So put together an all-star list that are trustworthy and have a good track record and a good temperament.
So I called out some of my favorite quotes from the book in a recent note to our members, Barry, and I'd like to get your reaction to at least one of them.
Sure.
Maybe a couple if we have time, but one that just stood out to me, and it's I think it rings true for so many of us here at the Fool and so many of our members. And I think it's certainly a lot easier to accept the older that we get. But the quote was, recognizing how little you know is a superpower. If we were less certain of ourselves and had more humility, we would all be better investors.
Yeah, no doubt about it. I named my blog The Big Picture because I'm a big fan of William Goldman. His first book was Adventures in Screenwriting, and his second book was The Big Picture. And I needed a name, and I just kind of stole that from him. But in the first book, Adventures in Screenwriting, my years in Hollywood, he throws out the line, nobody knows anything. And he talks about all of the Hollywood studios. They passed on Star Wars. They passed on Raiders of the Lost Ark. They passed on E.T. Like on and on it goes. And those movies just got made because through dumb luck, some random thing happened that ultimately led some, either a small studio or some junior executive to take a chance on something. But it's after, 100 other people had turned it down. Later on in the book, I talk about John Wick, which couldn't get made and has become a multi-billion-dollar franchise. When you think about what's needed to guess where we're going to be in 3, 5, 7 years, even 1 year, so much changes over the course of 12 months and so many random things happen. I like to point out, the year in preview, January 2020, nobody had a global pandemic shutting the global economy. Oh, and by the way, stocks will finish off the year up huge. Heading into 2022, nobody had the Russian invasion. Nobody had of Ukraine. We didn't see the, 500 basis points of Fed hikes. And then heading into this year, nobody had massive tariffs that are going to disrupt the global trade market and put a heavy thumb on U.S. equities, which have since recovered. It's always, and that's just as a perfect example, and this is policy, not politics. I don't think Trump did anything that he hadn't told all of us he was going to do.
Yeah.
He pushed tariffs in his first term. He went to Congress and asked for tariffs. It was Democratic, wasn't a one-party rule then, so it got rejected. But he made it clear, I'm tariff man. It's the most beautiful word in the dictionary. It was a collective failure of our imagination that he did pretty much what he said he was going to do. And so it just goes to show you how bad we are at forecasting what comes next, even when we're told, here's what's going to happen. So that requires humility. That requires a robust portfolio that can withstand a beating. It means we have to be very circumspect in our use of leverage, and we really have to be prepared for the wide array of possible things, all the many more things that can happen, that will happen.
All right, I got one more for you. It kind of fits in line with what you were just talking about there. It's being able to think long-term is a luxury that professionals do not enjoy. You can have a much, much longer time horizon. Daily, weekly, or monthly volatility doesn't matter to you.
Yeah, that's right. I mean, I know I have a lot of buddies who are fund managers, hedge fund managers, and forget monthly, they get calls, how'd we do this week? What's going on? Like a week is meaningless. It's noise. It's like a week doesn't tell you anything. We own this and we're short that, and here's how we think it'll play out over the next year or two. What does a week or a month or even a quarter mean? And so, you don't have to set up a fancy office as an individual investor. You don't have to do client calls. You don't have to put together a research team. You can say, here's the asset classes I'm going to own for the next 10, 20, 30, 40 years and see you from a higher tax bracket. That's a luxury. Having to deal with the demands, the alpha seekers having to chase these very high-profile clients who want to be brought up to speed, have questions about every little squiggle in the line. Man, that is a job I sure as hell don't want, because it's impossible. And then when we look at all of the various Morningstar and other reports on how these managers have done over the time, net of fees, costs, and taxes, it's less than half beat their benchmark in any given year. It's about 80% in 5 years, 85% in 10 years. By the time you go out 15, 20 years, it's practically nobody. It's more than 90% of these people are not beating the benchmark. And even within that 10%, the argument is randomly choosing stuff, you're going to have 10% beat the benchmark.
Barry, sticking with the theme of the money manager or professional, you've interviewed countless, you have friends, you run in those circles. Just focusing on those who you consider to be really good stock pickers, can you tell us some traits that you identify that they might share that allows them to be very good investors?
So I've interviewed from Fidelity Bill Danhoff and Peter Lynch, two legends. Danhoff, famous tech and small cap investor. Peter Lynch, a legend in the 80s and 90s. They had a very defendable process that was very suited to their moment in time. Bill Miller's another one. Had a great 15-year run of beating the S&P 500, ran into trouble in the financial crisis. After the financial crisis, again, shooting the lights out. Yeah. So, having a process, recognizing when a change comes that's going to undercut that process. David Einhorn's another one. Here's a guy who started as a value investor, did really well, underperformed for a while as value fell out of favor, in part due to the rise of indexing, and sort of realized, hey, I can't just do value. I have to do deep value, and then I have to find a catalyst. And sometimes that means, like a Boaz Weinstein, becoming a little bit of an activist. Boaz has done some really fascinating things. He figured out that a lot of closed-end funds are trading at 20, 25, 30% below the fair value of their holdings. And so his approach was to buy up a bunch of these and then force management to either open this up so it starts trading like an ETF at fair value, or buy back enough shares so it equalizes. But to be trading at a 30% discount when you're holding nothing but public stocks makes no sense. So sometimes you have to be innovative, sometimes you have to be creative, but the process and making sure that process is appropriate for the era we're in really seems to be something that's consistent with all of these people.
Would you say that process is consistent among those people, or
a variety of different processes.
Yeah.
All different processes, value, momentum.
But they stick to it. They've identified it. They've honed it over that time.
Being a fundamental stock picker is really challenging. You get a guy like Will Danhoff, who's been this long-standing, running a fund beating the market longer than Peter Lynch did. Yeah. Just a deep understanding of the catalysts that drive stocks. He's a guy that has adopted and changed and upgraded his model over time, his process over time. So being adaptable, it's a balance. How much do you adapt and how much do you stick to your knitting? How much you stick to your skill set and not change too much is always really, really difficult to do. When you see Ray Dalio is another guy who basically his first fund crashed and burned. He nailed the 87 crash and then expected another leg down when the market just recovered. And he's a guy who figured out, what's really important is learning from your mistakes and building the lessons of those errors into your model. And so you look at his whole growth from 87 to, let's call it 2020. Here's a guy that spent, about 30 years constantly incorporating what he learned when trades went awry and improving consistently. That model just got better and better and better. So learning from errors are absolutely crucial.
Barry, we intentionally avoid getting too political here, or at least we try. I mean, we're investors first and foremost, but I thought in the book you had a very good section of the book about how your politics are killing your returns. And I just wanted to see if you could expand on that a little bit, explain to our listeners what you mean by that.
Sure. So another academic study, they look at zip codes to see how they voted, whether they voted blue or red in any given presidential election. And then they went to a big data set of brokerage accounts, anonymized, just looking at them by zip code. And it turns out that if your guy lost in the election, your zip code voted for that guy, there's a tendency to lower your equity exposure dramatically. And if your guy won, there was a tendency to raise your equity exposure. And we could see that in the entire, everybody in the zip code cross-referenced with various brokerage statements. And what this means is that half the country is selling every 4 or 8 years and not allowing the market to compound over them. And so going back to 1950, the numbers were kind of crazy. I'm doing this off the top of my head. But if you invested only when Democrats were in office, a dollar would turn into 60. And if you invested only when Republicans were in office, a dollar would turn into 57. There's a chart in the book. But if you stayed invested the whole time, it turns into like $1,000. Like, the difference is just amazing. And so allowing your partisan views to influence your portfolio means you are interfering with the market's ability to compound money over time. I'm reminded of, don't just do something, sit there. Yeah. And it comes back to that behavioral bias we have. We have a hardwired bias towards action, right? I heard from a bunch of clients in 2020. I don't know about Sleepy Joe. I think I want to take my money out of equities. Hey, here's what we know. Here's how when he was vice president, how the markets did from 08 to 16. Why do you want to get in the way of that? And then again in 2024, I don't trust this Trump guy. He didn't do a great job with the pandemic. He's going to mess everything up. Hey, from 2016 to 2020, he did fine. The markets did great. In fact, the markets don't really care who the president is. They get way too much credit when things go right. They get way too much blame when things go wrong. Yes, certain presidents and specific policies, think about Nixon and Watergate or Johnson in Vietnam. There are all sorts of issues. Presidents can and do make mistakes. But for the most part, you just want to let the markets compound and not interfere with that. To imagine that you can predict what's going to happen with this policy and its effect on our trading partners and allies and how that's going to ricochet back. The title of one chapter was literally Love Trump or Hate Trump. That's no way to invest.
Yeah. Barry, yes, as we get ready to towards our end here to wrap up, I think that speaks as much just to the long-term compounding. I'm thinking, like, as we were making the turn of the century and the massive fears about Y2K or maybe it's a war or whatever it is. You mentioned some really turbulent times in the 70s, yet, as you pointed out, Morgan Hauser's pointed out, friend of the Fool, wrote the foreword, the markets have just, for the most part, compounded time and time again through all those ups and downs. And you quote about that quote about the markets hate uncertainty. Well, the markets are always uncertain to some extent.
That's right. Right. The future is inherently unknown and uncertain. And if the markets, the markets are occasionally certain, right? If there wasn't uncertainty, nobody would be on the other side of your trade. I remember in March 2009, everybody was certain markets were going to zero. Right. And I also remember in January, February, March 2000 that there's no limits for stocks. Hey, we're paying for clicks and eyeballs. Trees grow to the sky. And everybody was certain it was just going to keep going. When you get a group consensus like that, when you get that sort of certainty, it tends to lead to problems. You have to accept the fact that there is a lot of uncertainty out there, and there's supposed to be uncertainty. We don't know what the future is going to hold. We don't know what the next random event is going to be. We have no idea where the next war is going to break out, where the next pandemic is going to happen, what special shortfall, what innovation, what breakthrough is going to come. And here's the really challenging part of all this. I have this wonderful chart my partner Michael Batnick wrote. It goes back a century. There's another one just back to 2009. There's always a reason to sell.
Yeah.
And the reason there's always a cause, an issue, an event that gives you an excuse to sell is we are wired to see threats. Good things happen and it kind of sneaks by unnoticed. Morgan Housel noted that after the Wright brothers flew at Kitty Hawk, there was no news coverage of this. Wait, human, fast, heavier than air powered flight? It got no coverage in the media for 15 years. Some crazy period of time. we are not wired to see good things because good things are like, all right, things are okay. We are wired to see terrible things because terrible things represent an existential threat. And go back to the 2 million year lineage of humans, anybody who wasn't wired to see a threat, well, those genes are out of the gene pool. Those folks were lunch millennia ago, and the survivors are the ones who saw the threat. You know, it's always embarrassing when you jump or are scared about something. That little thing in the grass wasn't a poisonous snake. It was just a stick lying there. But hey, at a certain point in history, that might have kept your ancestors alive. And the fact that we bring all of this evolutionary baggage, we have all of our wetware was, the pharmaceutical industry calls this off-label usage. Right. This was not what we were designed to do. We are a cooperative species. We've survived despite lacking claws or fangs or armor because we're clever primates that have been able to build technologies and use tools and cooperate to our advantage. That doesn't necessarily help you in the markets. It's great on the savannah, but in the markets you have to step back and think to yourself, hey, is what I'm doing really going to help me over the long haul? And too often we fail to take that step and think through what our advantages are and how best to use them.
Barry, my final question before we wrap up here. AI in the financial industry, is it the snake in the grass, or is it the next version of the Wright brothers at Kitty Hawk and going to change the world?
So, so far historically, the Luddites have been wrong, and every new technology that has come along that has been promising to put everybody out of work hasn't happened. And we've heard this time and again. Yes, it'll change certain industries. The steam engine and leather belt businesses never quite enjoyed mean reversion. They went away and were replaced with something more productive, more efficient. I'm kind of fascinated by the idea of AI as a tool. I'm less concerned with the Magnificent Seven and more concerned with the Magnificent 493, the rest of the S&P 500, that will become more productive, more efficient, more profitable by deploying these tools. You know, the joke that's been making the rounds, and I think there's some validity to it, is you're not going to be put out of work by AI. You're going to be put out of work by a competitive person who has learned how to successfully use AI.
Right.
So coming up with a way to use this to make yourself more productive, more effective, more efficient. I don't fear AI. I want to learn how to use it. I've been a big fan of Perplexity because it's on the phone. It's so simple. It's so clean. And it's really useful. Yeah, there are still problems with it. There's still some hallucinations. We see that. But it certainly has become a very useful tool to making all of us better researchers, more knowledgeable, able to do more things. So I think you have to take it seriously. I don't think it's a flash in the pan. Think back to the 90s and the internet companies. Mm-hmm. Now, every company is an internet company. We all have websites. We all have emails. We're all on Slack or Teams or Google Hang or whatever. We use Zoom and Riverside, and we're all using the internet. I expect the same thing will eventually happen with AI.
Well, great words of wisdom from Barry Ritholtz. The book is How Not to Invest. Barry Ritholtz for joining us here at the Motley Fool. Thank you so much. Really appreciate it.
Oh, my pleasure. Thanks for having me, guys.
Barry.
It's been great.